Okay. So chapter 9 is going to be dealing with long-term assets. Our goals for chapter 9 are going to be to define long-term assets and issues associated with long-term assets. We're going to distinguish between what we have as capital expenditures and revenue expenditures. We're going to learn about computing depreciation in several different fashions. And then we're going to talk about the disposal of depreciable assets and identifying issues relating to what we call natural resources and depletion associated with those resources, and any issues associated with intangible assets. So, objective 1 is to look at long-term assets and the issues relating to them. First, a long-term asset is any asset that has a useful life of more than 1 year. It's used in the operation of the business, and it's not typically for resale. So like on one of your recent tests, I think there was a question that had to do with inventory. I think the answer was for a hardware store, and it was hammers. So clearly that would be an inventory item because it's a hardware store and they sell hammers, okay? In a long-term asset, these are typically things that would not be for resale. So they can have longer-term assets, but if it's a real estate business, then that might be something that's in their inventory. So that might not be a long-term asset for that type of business. So you've got to focus on those 3 factors to determine whether it's a long-term asset for that particular business. There are also long-term assets that are what we call tangible long-term assets and intangible long-term assets. Long-term assets that are tangible, you can touch and feel, okay? And intangible are things that have basically no physical substance, like an investment. Okay, you can have a long-term asset that's an investment that you can't obviously touch or feel. Things of that sort, such as trademarks or patents, those are also long-term assets that you can't touch or feel. Goodwill is another one. We also have to account for those. And then lastly, the other type of long-term asset are natural resources. So let's say I have land or some natural resource such as trees. If I have if I'm a company that is doing forestry or mining, those types of things would be considered long-term assets. Okay, so if we look at the classification, here's a little bit of a pictorial view of those items. From a balance sheet standpoint, we're going to classify them into tangible, natural resources, and intangible, and these are the different items that fall within those categories. And from an income statement standpoint, these are the expense categories that are associated with each of those different categories of long-term assets. So long-term tangible assets are typically depreciated. Long-term natural resources are typically what we call depleted, and then any long-term intangible assets are amortized. As they go down in value or the value decreases, we shift the asset's value to an expense via one of these 3 different methods, either depreciation, depletion, or amortization. When we are accounting for long-term assets, we want to focus on both the carrying value and the book value. That's why, if you recall, going back to, I think it was chapter 3, we were talking about the fact that we record the long-term asset at its carrying value, and we keep track of that carrying value, but as it depreciates, we report the asset on our balance sheet at its net book value. So it's just basically taking the cost of the asset less any either accumulated depreciation or accumulated amortization or accumulated depletion, and that gives us the net book value of that asset. As an asset is said to be impaired when the value of the long-term asset exceeds the fair value of that asset, and then at that time a loss must be recorded to decrease the carrying value of the asset to the fair market value. As a business, obviously, you hope that you don't have asset impairments. So when a business goes to acquire long-term assets, it has to make decisions regarding the value of those assets and what value they'll bring to the business over a long period of time, because they're going to keep that asset for a long period of time. So basically, they have to consider what the cost of the item is, any borrowing costs that they might have associated with that asset, such as interest or any fees. Like if you buy a house, there are a lot of upfront fees associated with buying a house. Same thing for any type of real estate that a business goes to purchase. Additionally, like things like if you're buying software, there might be costs associated with the installation of that software. There might be fees associated with getting training or development from the company that is you're purchasing the software from. So all of those things have to be taken into consideration, as well as what are the benefits going to be. Okay, so here we look at this particular business. Apple management is considering buying a $100,000 software package, and it estimates that the software will reduce cash outflows by $40,000 a year over a period of 4 years. The useful life of the software and that of the software will be worth $20,000 at the end of that useful life. Okay, so basically that they're estimating that they're going to save about $40,000 a year with that acquisition of that software. Maybe they think they're going to have less employees, fewer salaries that they have to pay, maybe less hours that people have to work. Who knows? Whatever the factors are that go into their decision, they're going to factor that in. Because typically you have an upfront cost, but you want to factor in if that upfront cost is going to be worth it to me because I'm going to save money in some other fashion. Okay? So that's what they're doing. They're doing an analysis of the outflow here and then the annual savings, and is it worth it to them at the end of the day to have purchased that particular software. And for them, they're saying yes, it was positive. In the first year it was negative, but then thereafter they're saving an additional $40,000 each year, so it becomes a positive benefit to them as a company. So their analysis would be that it would be beneficial to acquire that asset, and so therefore they probably would. So what they do is, as long as what they call the net present value of the asset is positive, in their case they're saying it will earn at least 10% on the investment, and their return on this and a net present value perspective is $40,000. So they should purchase that software. Okay, so they're saying that if they had purchased, instead of purchasing it, if they had invested it, they would have earned X amount of dollars versus purchasing the asset. They still come out, in their estimation, $40,000 ahead. So they will go ahead and do it. And this is very typical. Most businesses do some sort of analysis before they go out and acquire something. Just like you guys would. When you're going to, like, say, buy a car, you're going to do some sort of analysis of the cost of this car versus the cost of that car, and how much maybe your gas is going to be in this car versus that car, maybe how much the insurance is going to be in this car versus that car. You're going to figure it out and try to determine which car makes the most sense for you to purchase. They look at what we call free cash flow. It's the amount of cash that remains after deducting the funds that the company has to commit to whatever the new operation is. So we did that free cash flow analysis when we did chapter 13. You guys did that. You looked at free cash flow. You're going to do that same type of thing as it relates to your financing of long-term assets. Okay. Businesses are going to apply what we call the matching rule, as we've talked about before. And they're going to ask some questions. How is the cost of a long-term asset determined? How should the expired portion of the cost be allocated over time So that's the depreciation or the depletion or the amortization method that you would use, and that's what we'll spend some time looking at in the next couple of classes. How should subsequent expenditures be handled? So for instance, if you have a long-term asset, you can assume with a long-term asset that you're going to have to make some sort of investments in that asset over time. Just like you with your car, okay, you're going to have to put new brakes on your car. You're going to have to maybe get oil changes for your car, things like that. Well, businesses have those same type of expenditures on a long-term asset as well to keep that long-term asset in optimal condition. And then lastly, at the end, how are you going to dispose of that long-term asset? And this is just a little picture describing how the acquisition price is over here at the beginning, and then what we call declines or expires over time. And then you factor in what the recording of the disposal is going to do for you. Are you going to have any gain or loss on the sale or disposal of that particular asset at the end? We're going to just not bother with this problem right at the moment. Okay, so we're going to look at distinguishing between we're going to stop here and